Hello everybody. Today we are going to talk about a pencil startup project. We choose as a target market Bulgaria and propose to locate our pencil production plant in the city of Medan, Bulgaria. It is located near cedar forests and factory for metal goods, which will assure relatively cheap materials for our production process. Additionally, our presence in the region could be beneficial for the local economy, and the labor cost in that region is relatively cheap, which is favorable for us. Our operation flow consists of 3 production lines. In the first production line, the wooden slats go through a conveyor belt where grooves are carved on the slats. In the next line, the lead is placed in the grooves, glue is added, and additional slats sand to which the lead. The pencils undergo quality check. In line 3, the pencil is painted, and a metal ferrule with a rubber eraser is attached. Considering our production process, we choose a process costing system. We estimate the prices of raw materials based on current data from online stores and catalogs of local producers. We then calculate the cost of direct labor. We find the depreciation rate of the machines according to the legal standards and find the total overhead. By comparing the prices of leading international and Bulgarian manufacturers, we reach the conclusion that 1.80 lev is a reasonable price per unit, which will even be the lowest in the market. From this table we can see that we are offering the lowest price for the Bulgarian market. Our local competitor is Molivko, manufactured in the outskirts of Sofia, which sells a batch of pencils for BGN 1.82, a price considered to be quite competitive. However, we have managed to offer a price below theirs because we are a new company and we need to enter the market as effectively as possible. Our other worldwide known competitors are the German supplier, Faber-Castell, BIC, Dixon and Derwent. In a pro forma income statement, we obtain an annual net income of 126,274 leva. Each month we expect a slight increase in the number of units produced. However, things on the market not usually happen as expected. That's why we present you a second pro forma income statement, with a drastic decrease of 50% in units sold. We start with smaller numbers in the first couple of quarters, but we show a growth in the third quarter, and a slight decrease in the last one, a pattern followed in both pro forma income statements presented. The cost of goods sold for all 4 quarters is 304,567 leva. It is a smaller number compared to the previous projection due to the fact that less raw materials and less direct labor hours are used in the manufacturing of our product. Considering the production line optimization process and other calculations, it appears that by decreasing the number of units sold by 50% leads to a decrease in the cost of goods sold of 40–50%. Another major strength from the high-tech production line is that the machines have the option not to work at full capacity and in energy-efficient mode. Furthermore, utilities expenses decrease by 60–70%. Since we expect not to be that busy, transportation and conveyance expense also decreases substantially, 60–65%. The changes in all these expenses determine the lower net income. However, the outcome is pretty satisfactory, keeping in mind we reduced our units sold twice. The net incomes in both pro forma income statements appear to be stable with no net losses expected. Now you will see our break-even analysis, provided with a unit contribution margin graph and a variable cost per unit graph. From a unit contribution diagram, we concluded that variable costs per unit equal 78% of the selling price per unit, while the unit contribution margin is 26%. In a break-even analysis we found that the break-even quantity for one period is 9,361 batches. Here is presented our whole break-even analysis. As you can see, we get our total sales by multiplying the price per unit, 1.80 leva, with the sales volume per period, 50,000 units, and we acquire our 90,000 leva of total sales. We get 1.773 leva for direct materials. Our variable costs per unit equal 1.4023 leva. When we multiply our variable costs per unit with the sales volume per period, we get total variable costs of 70,177.30 leva. Our unit contribution margin is 0.40 leva. Furthermore, by multiplying the unit contribution margin with the units sold, we obtained our gross margin, which is 19,882.70 leva. Our rent is fixed. We have no insurance or property tax, and in the end we have all other fixed costs that we haven't included yet, summed up. By adding up all other fixed costs we get BGN 3,722.43. In order to estimate our net profit or loss, we subtract our gross margin, which is 19,882.70 leva, with our total fixed cost, and we get a net profit of 16,160.27 leva. Our margin of safety is 40,639 units, Oregon 81%. This is a very good percentage. It indicates that sales should decrease by that much percent in order to break even. Our leverage is 1.23. One of the reasons it is so low is our expectation of high profits. Madden Pencils breaks even at 9,361 units. By selling 10,000 units we would have a profit of 254.11 leva. Our selling price and fixed costs remains the same, BGN 1.80. Throughout every period, we get our variable cost are determined by multiplying our variable cost per unit, which is 1.4023 leva, with the quantity. Furthermore, the desired total sales are acquired by multiplying the selling price with the desired quantity, and the difference between the total costs and the total sales gives us the net profit. At a discounting rate of 15%, we obtained NPV of 236,273 leva. This value is acceptable because it is greater than the required rate of return. The internal rate of return with these assumptions turns out to be 0.51. This is quite far above the required rate of return, so the IRR method also tells us to invest. Yet, such a high value might not be realistic. According to the payback method, the payback period is 2 years. This fact on its own doesn't tell us much. It only indicates the time necessary to recover the original investment. Thank you for your attention.